right, welcome everyone. This is session 8 of the Forbes Mazars Pillar 2 technical series. Today we are going to cover GloBE reporting and compliance. First of all, I want to thank everyone for taking the time to attend. I know this is a busy time of year, and we appreciate your participation on these series, and we hope you find them insightful. Just a real quick recap of the series so far. So we've kind of built up, our technical topics throughout the series with an overview, walking through determination of a multinational enterprise group, tax accounting overview, computation of GloBE income, and computation of adjusted covered taxes. And then last session we had, we covered GloBE elections and flow through entities. As part of the recap, I wanted to also talk about our agenda today. So we're going to have a quick discussion on Pillar 2 accounting and disclosures, notification requirements relating to Pillar 2, and then we'll cover the GloBE information return and QDMTT returns. Our presenters today, myself, Eric Flickier, I'm a partner with Forbes Mazars U.S. International Tax. Also presenting with me today is Elizabeth Ruck with Forbes Mazars Germany, and Laura Shoemaker, manager with Forbes Mazars France. Like we've done in previous series, we just wanted to do a quick recap, just cover some very basic terms that the audience has this in their background. So, Pillar 2 is all driven by the top-up tax and charging provisions, and those are the qualified domestic minimum top-up tax, which we'll talk about today in quite a bit of detail relating to compliance, which is just a domestic minimum tax that qualifies under the Pillar 2 framework. There's also the income inclusion rule, which is a top-up tax that allows for a parent to top up the tax of a low tax income in a constituent entity. And then there's the underpayments rule as well. Just a quick overview of the top-up tax computation itself. We covered this in previous sessions, but essentially we have a goal of hitting an effective tax rate of 15% in every jurisdiction. So there's a computation of the actual GloBE ETR, the effective tax rate in each jurisdiction that's computed, basically taking GloBE income divided by adjusted covered taxes to get to the effective tax rate. And if we are below 15%, then there's a possibility of a top-up tax if we have excess profits, which would be net GloBE income less substance-based income exclusions. So we've got some carve-outs for income that's not subject to this top-up tax. If we do have excess profits and an effective rate below 15%, then we've got a top-up tax liability in the jurisdiction that we're looking at. And finally, we just wanted to show the calculation steps again. This is everything that's done to get to actual compliance and reporting. So walking through determination of the multinational enterprise group, GloBE income and adjusted covered taxes, the actual computation of the effective tax rate and any top-up tax liability by jurisdiction, and then the application of the charging provisions. So all of this information that we covered in the previous sessions is all going to eventually need to be reported. And that's what this session is covering, reporting of the Pillar 2 activity for a multinational enterprise group. And with that, I will turn it over to Laura to talk about where we're at with implementation of legislation related to Pillar 2 throughout the world.
Thank you, Eric. So I will begin with an overview of Pillar 2 implementation. As reminder, 130 countries have signed on the OECD framework, indicating a broad international consensus. As of late 2023, many countries support Pillar 2, and several are working on laws to implement it. However, implementation faces challenges, including political resistance in some countries and also complexity in aligning national tax law with the global framework. As shown on this slide, countries are at the various stage of implementation. Some have already introduced domestic law to align with the OECD framework, while others are in the process of drafting legislation. So today, 34 countries introduce IIR rules, 37 countries domestic top-up tax, and 27 new TPR rules. So we can see that some countries introduced or plan to introduce only domestic top-up tax, such as Brazil, Barbados, Mauritius, Bahamas, or Bermuda. Some only introduce IIR rules, such as Japan, or only IIR and UTPR rules, such as South Korea. So this shows that there is no common approach in the implementation of Pillar 2. And we can see also that the number of jurisdictions evolve from day to day. For example, Gibraltar enacted GMTT end of December, so less than a month, that is applicable for fiscal year 24. So close monitoring of Pillar 2 implementation is key to manage Pillar 2 within a group. In terms of deadlines, so starting from fiscal year 24, the transitional CBCR safe harbor is applying. So if a jurisdiction is safe harbor, no further works have to be performed. But if a jurisdiction do not benefit from the transitional safe harbor, the full model rules will apply. And in this case, the top-up tax should be calculated and the provision should be booked at the level of the low tax entity or at the level of the UPE, so the ultimate parent entity, or the partially owned parent entity at the level of the POPI. And this depends on the implementation of Pillar 2. Elizabeth will provide further detail in the next session. And the same process will apply for fiscal year 25 and fiscal year 26. So 18 months later, groups must file first the first GloBE information return, even if all the jurisdictions of the group are safe harbored, and two, the local returns, the QDMTT returns, in each jurisdiction where that do not benefit from the transitional safe harbor. And at the same time, any payment of top-up tax for fiscal year 24 should be made in the jurisdiction where the liable entity is located. It is important to highlight that the deadline for DMTT returns may vary from a jurisdiction to another, and in some jurisdictions may require advance payment. I maybe forgot, in the meantime, the group might file jurisdiction notifications, which according to GloBE rules has to be filed in the same time of GloBE information return. But we observe that in many jurisdictions, this notification have to be submitted prior to that date. So we recommend so it's why we recommend monitoring compliance on jurisdiction by jurisdiction basis. And so last step in three years, so end of 26, the transitional safe harbor will come to an end and the full model rules will apply. However, it is important to remember that permanent safe harbor will apply that can reduce the top-up tax exposure, and we recommend to extend Pillar 2 reporting to all entities within the group. So during this webinar, we will go through all these compliance requirements with the first in date, the top-up tax provision, and Pillar 2 disclosure, notably applicable for fiscal year 2024.
All right, and here's our first polling question, and we're going to have 4 of these throughout the webinar. So, has your company developed a plan for Pillar 2 tax compliance and reporting? Yes or no? And we'll give a minute or so to answer this question. And And Laura, Elizabeth, it'd be great to hear some of your thoughts here, but have you had conversations with companies about, it seems like the common question is, I want to understand, what is due when and where in the countries where I'm located at. So I'm seeing more and more conversations around that, around compliance with Pillar 2 over the last month or so. I don't know if you all have seen that as well.
Yeah, go ahead, Laura.
No, go on, Elizabeth.
No, I just wanted to add that we indeed have seen those questions. They are coming up very often. And a lot of entities or a lot of groups are trying to establish a jurisdiction calendar, like a tax jurisdiction calendar, where they track all the compliance requirements in the different jurisdictions, just to be able to fulfill all those requirements, because they can be so different.
Yeah, that's really that's really kind of what the goal is right now. And all right, so we've got the polling questions in. It looks like we're about 50-50 yes and no. That seems to make sense. I mean, there's a whole lot of questions around Pillar 2 compliance and reporting. So trying to get a handle on it, but also not do too much without knowing what the actual compliance will look like. All right, I'll pass it over to Elizabeth here to talk about Pillar 2 accounting and disclosures.
Thank you. So I will try to answer the question that a lot of people have, which is which entity is the entity that has to book the Pillar 2 tax provision in their financial accounts, and which entity is liable for top-up tax in the end. And right now, currently, there are two cases possible. The case one is that there is no QDMTT, so no qualified domestic minimum top-up tax in a low tax jurisdiction. So in this case, the UPE or the POPE will perform a full GloBE calculation under the income inclusion rule, so when there is no QDMTT. And if the effective tax rate is under 15%, the UPE or the POPE will compute the amount of top-up tax with respect to their inclusion ratio, meaning the ratio that participations are held in low tax constituent entities. And then the UPE or the POPE will book the top-up tax provision in their accounts, and they will be liable for the top-up tax in their jurisdiction. So everything goes up to the most upper entities in the group. But then we have the other case 2, where there is a QDMTT in a low tax jurisdiction. And in this case, the low tax jurisdiction entities will perform the calculation under the local rules. And then if the effective tax rate is below 15%, the top-up tax will be calculated in that jurisdiction and will be allocated to all the entities in that jurisdiction according to the national law. But at the same time, the UPE and the POPE will perform the calculation under the IIR rule, and then the amount of QDMTT will be imputed to avoid double taxation to the amount of top-up tax for those entities. So this is the common sense of that. We have to take care, so there may be the possibility that a domestic minimum top-up tax is not qualified, so it is no QDMTT but a DMTT. Then it might come to a double taxation, and there will be no imputation of the top-up tax calculated by the POPE or UPE. But there is the possibility that if the QDMTT safe harbor applies, no calculation under the income inclusion rule should be performed. So if that's the case, then there is no calculation necessary. This said, I will move on to a little case study. We have two. We have one for the case where no QDMTT in the low tax jurisdiction is applicable, and then the other case with the QDMTT. So let's look at that. We have a ACO in country A that is participating with 60% in BCO in country B. Both country A and country B have the income inclusion rule implemented. And then we have CCO in country C, where also the income inclusion rule is implemented, but country C is a low tax jurisdiction. BCO in this case is a POPI because it has an ownership interest in another constituent entity of the group, and 40% of its ownership interests are held by non-group members. And then there is a CCO, which is a low tax constituent entities, and we have calculated 10 million top-up tax for CCO in country C. So BCO is required to apply the income inclusion rule, and as a POPI with interests in CCO, at the same time, ACO is also required to apply the income inclusion rule as the UPE of the group, the most upper entity. So you can see in the table below, we have an inclusion ratio of 1, so 100% for BCO, and 0.60% for ACO in CCO, which leads to an allocable share of top-up tax of 10 million to BCO and 6 million to ACO. But we can do the IIR offset, meaning that ACO can offset 6 million top-up tax because BCO is already paying top-up tax, leading to a final top-up tax liability of 10 million at BCO level. So BCO will be the one to book the tax provision in its financial statements in country B. Let's move on to the next case, where we have the QDMTT. It's basically almost the same example, where we have ACO in country A, we have third-party interests, and we have BCO in country B. BCO is still the POPI of the group, and then we have not country C, but Germany in this case. And in Germany, there is an IIR and a QDMTT in place. And Germany is, in this example, the low tax jurisdiction. We have a German company 1 with GloBE income of minus 150, meaning a GloBE loss and no adjusted covered taxes. And then we have 2 German entities with GloBE income of 150 each and adjusted covered taxes paid of 7.5. In this example, Germany Co. 1 will not be a low tax constituent entity because it does not have GloBE income. So it's only the entities that have GloBE income that are considered as low tax constituent entities. And if we do the calculations, which you can see on this slides, there will be a top-up tax due in the amount of 7.5 for Germany, and Germany Company 2 and Germany Company 3, according to the German regulations, will be the entities liable for the QDMTT, and they will book the tax provision in their accounts. So unless, like the other example, the top-up tax stays in Germany, still BCO and ACO will have to do the computations under the IIR, which is implemented and applicable, but they can offset the QDMTT paid in Germany. So in the best case, there will be no top-up tax at the level of ACO and BCO. All right, let's move to the disclosure requirements in the financial statements. of the entities. So as possibly most of you know, IRS 12 was amended because of the new Pillar 2 regulations. There are few new regulations concerning deferred taxes, as well as information that has to be mentioned in the appendix. And the amendment specifies that, so you see IAS 12.88a, that the entity shall disclose that it has applied the exception to recognize and disclose information about deferred tax assets and liabilities related to Pillar 2 income taxes. So this should be mentioned in the appendix. Then under 1288b, there will be the current tax expense that has to be disclosed, and IAS 12.88c and d concern periods in which the jurisdiction is not yet affected by the Pillar 2 rules, but will be. So in years before, there has to be some qualitative information and quantitative information disclosed according or under the IAS 12 amendments. And that said, we will look at the national regulations under local GAAP. I will hand over to you, Eric, for US GAAP.
Yeah, thanks, Elizabeth. So for US GAAP, the FASB has announced guidance on this, and there's according to the FASB announcement February 2023, they view the GloBE minimum tax as an alternative minimum tax subject to accounting as outlined in ASC 740. So there's a current inclusion approach. There's no deferred tax accounting relating to this. There is a consideration for discrete items and intra-period allocation if there is an adjustment from a prior period. Differences in practice are beginning to emerge. So we were seeing valuation allowance considerations. If a VA is going to be impacted by Pillar 2, what does that do for the financial accounting disclosure? We're expecting future guidance on this. Most firms are considering this an accounting policy election, and the disclosure should be included in the tax footnotes. That's one thing that we are working with our clients on. Some companies are providing updates as to what they expect the future impact of Pillar 2 would be, but there is a disclosure that is included in the footnotes relating to any Pillar 2 tax liability. And back over to Elizabeth for German GAAP.
Yes, thank you. So generally speaking, under German GAAP regarding deferred taxes, deferred tax liabilities, they have to be recognized in the balance sheet, while the deferred tax assets can be recognized. That's optional. And that section was amended in Germany, saying that there is a exception to the recognition of deferred tax assets and liabilities linked to the application of the GloBE rules. So beside this amendment, there were some other amendments regarding the annex of the financial statements, which you can see here. So for financial years beginning before the introduction of GloBE, there have to be some qualitative information and as far as possible quantitative information disclosed. And for financial years beginning after the introduction of GloBE, the tax expense or income that arises from the application of the GloBE rules are to be disclosed right now. So this basically goes with the IAS amendment. They just included it into the German law. And I will hand over to Laura that will speak about the French amendments.
Thank you, Elizabeth. So in French, GAP is very close to German GAP, so I will be brief. So the ANC regulation have been amended also. So before, the regulation established the principle of mandatory recognition of deferred tax for all taxable and deductible temporary differences. And the amendment now provide an exemption and a definitive exemption to the recognition of deferred tax assets and liabilities linked to the application of GloBE rules. So the IFRS provide with a temporary exception, and German and French GAP, the exemption is definitive. And in terms of disclosure, so for financial beginning after the introduction of GloBE rules, because in French it's already introduced. In addition to the breakdown between current and deferred taxes, the appendix of the financial statement must also disclose the tax expense recognized in respect to the GloBE rules. It's a line, a dedicated line there is a dedicated line for Pillar 2.
Okay. So yeah, next point question here we have, will your company be subject to a qualified domestic minimum top-up tax for the 2024 tax year? Yes or no? This may be something that a lot of companies are trying to figure out at the moment, as for especially calendar year companies, trying to determine if there is a 2024 liability, depending on the jurisdictions that they are located in.
Especially looking at the fact that the law is so dynamic, meaning, as Laura mentioned in the beginning, there is the country that just implemented a QDMTT end of December 2025. So 2024, yeah. Sorry.
Yeah, not applicable for fiscal year 2024, and so we need to be reactive on the analysis of the local regulation in order to comply and compute with the good method.
Yes.
All right, so we've got about a quarter of our audience here saying that they expect their company to be subject to QDMTT in 2024, and then the rest saying no. So yeah, that is something that is a moving target at the moment.
But maybe
yeah. All right, notifications. I think this is for Laura now.
Yeah. Yes, thank you. So notification for Pillar 2 purpose. So what is the notification? So the notification refers to the process by which groups inform the tax authority about their compliance within GloBE framework. The notification serves to inform tax authorities about the entity within the M&E group that are subject to GloBE rules, as well as their compliance status. So it helps tax authorities to understand the structure and operation of M&E group. So in terms of content, the notification typically include information such as identification of the entity within the group that are subject to GloBE rules within the jurisdiction, and identification of the entity that is filing the GloBE information return and the jurisdiction in which it's located. In terms of timing, the OECD, as I said earlier, aligns the notification deadline with the filing deadline for GloBE information return. However, some notification must be submitted within a specific time frame, which may vary by jurisdiction. So we should have in mind, that failure to notify or provide accurate information may result in penalties or increased scrutiny from tax authorities. So it's important to comply with this requirement. And we have some jurisdictional variations, so the local approach. So the local tax authorities are free to determine the modality of notification. And there is also specific requirement or content that local tax authority may ask. I think the next slide is a good example. So Belgium example, it's a good example of local variation. I think it went further than the OECD requirement by asking for a comprehensive description of the structure of the group with the identification of the UPE, so it's normal, the intermediate parent entities, the partially parent entities, the minority-owned parent entities, and the jurisdiction in which they are located. So I think, as of date, I think this is the most comprehensive notification that I see. And maybe, Elizabeth, you can have a couple of words about the German one, that I think it's very close.
It's not that extensive as the Belgium one, but for example, in Germany, it's called the group head notification form, which, by the way, will be due end of February if your financial year corresponds with the calendar year. So keep in mind that for Germany. It just says that the German group head, it may be the UPE if it is located in Germany, but if the UPE is not located in Germany and there's only one entity in Germany, that would be the group head, has to be identified to the German Federal Tax Office. So it's a very comprehensive form that can be digitally transmitted to the German authorities.
So regarding notification, there is some consideration to have. So depending on local requirements, either a local entity or ultimate parent entity should carry out the notification. The MNEs may choose to engage an external service provider when it's feasible. But it is important to note that in some jurisdictions, such as in Singapore, the external advisor must be locating within that jurisdiction. So we cannot do what we want. And additionally, the form, the content, the filing process may vary from a jurisdiction to another. So the key of success for this compliance is MNE must have a clear view on Pillar 2 perimeter, on the qualification of the entity, and in particular the UPE, that is not always straightforward. And additionally, group need to closely monitor local regulation and be prepared to react swiftly, because deadline can be very tight.
I think the takeaway here, and this is probably the comment that can be made throughout the presentation, is that local country requirements can vary, and it's a difficult task to try to be on top of every jurisdiction that we're in that have rules implemented. So just having that calendar, having that way of tracking tasks is going to be important for companies that are subject to Pillar 2.
Yeah.
And this brings us, thanks, Laura. This brings us to the next topic, the GloBE information return. In this topic, it's very very fresh, because the OECD just recently released in January 2024 the new GloBE information return version. So as we have seen before, the local regulations may vary. This is why the OECD has intended the GloBE information return. So it's to improve coordination between the implementing jurisdiction and trying to reduce the administrative burden that that are faced by the groups. So they try to provide a standardized information return that can be submitted to the respective administrations. And usually, according to the OECD model rules, the deadlines for transmitting the GloBE information return is 18 months for currently the transitional year, and then it will be 15 months when the transitional period is over. However, also in this case, it is possible that some jurisdiction may require an earlier filing deadline. So this has to be monitored as well, looking at all the jurisdictions. The next question to address is who is obliged to file the GloBE information return and where. So the basic rule here is that each constituent entity has to file the GloBE information return in their jurisdiction, or there may be a designated filing entity, but according to the general rule, it's still in each jurisdiction. However, there is a exception where the UPE or a designated filing entity may file the GloBE information return, but there has to be a qualified competence authority agreement in effect. It's quite the same as with CBCR, so there has to be this agreement. And this may then remove the obligation to file a GloBE information return locally. So I will hand over to Laura.
Yeah. So regarding the content of the GloBE information return, is divided in 3 parts. I don't know. The goal is not to go deep in to go in details, but we have to note that the OECD published today an explanatory guidance, data point by data point, that is very useful for everyone, I think. But the structure of the GloBE information return remain the same as described here. So 3 parts: M&E group information, jurisdictional safe harbors and exclusion, and GloBE computation. So the first part is general information, which includes details on the reporting entity, about the reporting fiscal year, the financial and accounting use, the currency, also the corporate structure, so the identification of the UPE, the constituent entity, the member of the JV groups, and identification also of the excluded entity. And what is interesting is the high-level summary of GloBE information that should be performed jurisdiction by jurisdiction. That it is a summary, so you have to indicate whether a safe harbor is applicable, the UTR of the ETR of the jurisdiction, the amount of top-up tax payable under GMTT, and the amount of top-up tax payable under GloBE rules, so IIR or UTPR. And this table as many as the number of jurisdiction. And the 2 parts is the same. So the filing constituent entity shall complete these 2 sections on jurisdictional basis. So the second section, if the jurisdiction is applying exception to the GloBE computation. And the third part, is to be filed if jurisdiction do not apply exception to the GloBE computation. So, and GloBE computation part is, I think, the most comprehensive one, because it details all the GloBE income, cover tax adjustment, allocation between jurisdiction and entity, the election made, the jurisdictional or and by entity elections. So here it's the detailed computation, and this GloBE information return aims to provide the tax authority with a comprehensive overview of the M&E global tax position. So this ensures transparency and compliance with the minimum tax requirement. So it is, and there might be also a local variation, but very small, because the OECD expressed and stressed today in the guidance published today that the goal is to have a standard template and a common approach about the GloBE information return. So in term of form, maybe it's where the jurisdiction have the freedom. So each jurisdiction is free to choose the format, is free to choose the form and the format, so XML, PDF, sorry. And as I said, the content must comply with the OECD requirements. Maybe a little study case, Elisabeth.
Yes, thanks. So we have another study case here where you can see a US UPE that holds 100% of two constituent entities in Belgium and Ireland, and then 75% in CE3, which is a French constituent entity, and the French constituent entity holds shareholdings in 3 other constituent entities. So constituent entity 3 here is a POPI. And as we know that the United States did not implement the GloBE rules, the question will be here in which country the GloBE information should be filed. So looking at what I've said earlier, generally speaking, each constituent entity is obliged to file a GloBE information return, at least in the jurisdiction where the GloBE rules are applicable. However, there is the possibility to have a designated entity file the GloBE information return, and if there will be qualified, qualified competent authority agreements between the European entities, we can refer to one European entity to file the GloBE information return.
And maybe I would add that it may be beneficial to select a jurisdiction with the highest number of qualified competent authority agreements signed to reduce the number of GloBE information return that need to be filed. And for example, French tax authorities will publish in the coming months the list of jurisdictions with which France have signed qualified competence authority agreements in order to have a clear view on the compliance requirements.
And the benefit of that, just to clarify, the benefit of that is if we have that ability to file in a country that has competent authority agreements, then that could eliminate the need to file in other countries, at least the GloBE information return. So, this is for, U.S. headquartered companies here. There's still going to be a GloBE information return that has to be filed, right? And then in this case, in this specific example, seems like there's the ability to choose between constituent entity 1 and 2. And then, as Laura's commented, it seems to make sense, that finding the jurisdiction that has the most agreements to eliminate the need for compliance, and even more jurisdictions would be worthwhile to look into.
And looking at the questions in the Q&A section, there is one question saying, or the question is whether each constituent entity has to file the GloBE information return. So generally, yes, it's Article 8.1 of the OECD model rules. But if there is a designated local entity, then there's only one GloBE information return in that jurisdiction. So then it will be on jurisdiction basis. So if a designated local entity is appointed, it's only one per jurisdiction and not as many as there are constituent entities. And then looking at the next question.
I think we're going to reply in the next section, no?
Yes, yes, the question is going to be answered.
Yeah.
So just wait a little bit, and if it's still not clarified after the next section, we can connect and talk about it if it's still not clarified. So let's move on.
So maybe the consideration to have, and I think it's going to be the same that we say since the beginning. So define an internal calendar and keeping in mind that the GloBE information return preparation or deadline can coincide with the audit period in some cases. Define an operating model, so and define the roles and responsibilities of the stakeholder. I mean, the MNEs have to decide if they are managing the compliance internally, externally, through a tool or not. And the use of tool can be really helpful for this new huge global compliance framework. And moreover, when we add the filing of local returns that we will present in the next section. Sorry.
All right, here's the third polling question. Are you interested in a follow-up consultation with Forbes Mazars relating to Pillar 2, yes or no? We'll give some time here to answer that, but I guess for the sake of time to get through the rest of the slides, we can cover the QDMTT returns while everyone answers the polling question.
Yes, maybe we can start to move on. I can start with the QDMTT returns because the polling question was an easy one, I think. So the QDMTT returns, as said earlier, those are very local specialities. So each jurisdiction is free. There is not much guidance on those to determine the modalities to complete and file the QDMTT return. So the form is different, especially except Belgium. It's still work in progress. We will have to wait and see what it will look like. It's still in question who is the special designated entity of the jurisdiction, the service provider, the platforms of the jurisdiction, so how those returns are gonna be filed. Penalties is very different in each jurisdiction. So this is a very moving topic that may change and will change over time. So that's gonna be, it has to be monitored. And then I will hand over to Laura, who will mention some example of QDMTT specifications.
And I think I will reply to the polling question. So do we have to file a QDMTT separately, or there is an option within the GloBE information return, like a box that we can tick? So, and as we can see, so the QDMTT may have specificities in terms of calculation. So you will have to compute the QDMTT and compute your IIR and file for the two returns. But if the QDMTT is safe harbored, so the QDMTT safe harbored, so it's going to be with the jurisdiction will evaluate themselves if their QDMTT is safe harbored, and if they said yes, you don't have to compute under IIR, and you're gonna check the box in the GloBE information return that you are safe, QDMTT safe harbor in this jurisdiction. So in terms of QDMTT specificity, little discretion that in computation there is difference, but this difference do not impact the qualifying nature of the DMTT. So there is difference, but it's okay, it's still a QDMTT. So first, it may have specific calculation method, meaning that jurisdiction have the possibility to make the QDMTT more restrictive than the GloBE rules. For example, the threshold regarding fine and penalties may be set below the 50K. So the OECD provides jurisdiction with the option to align certain adjustment with the local tax adjustment. Other difference is the financial accounting standard. For example, in Ireland, the Irish GAAP must be used for local tax top-up tax computation. The QDMTT is not required to have the substance carve-out, so the excess, so the substance carve-out, or the jurisdiction may decide not to adopt the transitional percentage and apply 5% carve-out from the first year. So this is really game-changing to assess the top-up tax exposure within the group or within a jurisdiction. And the QDMTT may be applicable only to fully owned entities, like in Australia, sorry, if I'm not wrong. So there is differences, and the amount of QDMTT, so paid locally, can differ from the amount of top-up tax calculated under IIR.
Yes, and I will talk about the deadlines. I just have a little German specifica to add regarding the QDMTT specialties. For example, what the German lawmaker said, they just said, okay, if you have a top-up tax calculated under IIR, that will be the German QDMTT. So it may be very complicated, it may be very easy, it depends. And so here you have the deadlines. That's also a thing that each jurisdiction is free to determine. So as you can see, most jurisdictions provide the same deadline as the GloBE information return, meaning 18 months for the transitional year and 15 for a standard year. However, there are some jurisdictions that are doing their thing. They have a specific deadline. So, for example, here, Austria with 20 months, which is okay because it is longer than the GloBE information return deadline. But then you have jurisdictions that have shorter deadlines than the one for the GloBE information return, as for example, here, Belgium or Turkey and Vietnam. So those, we have to look out for those jurisdictions in order to meet this local compliance issues. So this is a thing that also has to be kept in mind. And then let's move on to the next slide. Having said this, the key of success, as we have said earlier already, there has to be a process defined to handle those compliance requirements. We have to track the different jurisdictions and their national specifica. An internal calendar is very useful for that, to monitor the QDMTT and the GloBE information return deadlines. And then also what we have come to see as a huge factor of success is that you have to define roles and responsibilities for the stakeholders, which responsibility is to monitor those deadlines, to monitor whether the process is being followed. So those is really the key to success, to keep all those compliance stuff in mind. And now let's move on to the polling questions because we only have 2 minutes left.
All right, final polling question. Are you looking forward to compliance with Pillar 2? Yes or no? Just thinking about the last couple of slides here, I think it really hits home that, you know, there's going to be a huge coordination effort with this. There's going to be a need to have local advisory in each jurisdiction, advising on the nuances of, like Elizabeth just made an example with, you know, the QDMTT with regard to Germany. It's going to be completely different than other jurisdictions. There could be different, you know, stances on the transitional safe harbor rates. So a lot of things that need to happen at the local level, and then coordinating that with some sort of process to coordinate it from a centralized approach. And then also, you know, there probably is going to need to be a need for an investment in some sort of tool to handle all this. So here's the final polling. Looks like the majority of folks here are not really looking forward to compliance with Pillar 2, which is probably what I expected. But with that, I appreciate everyone's time. Again, like I mentioned, it's a busy time of year for a lot of companies, and we really do appreciate your attendance. And if there are any questions that you want to ask, feel free to reach out to our presenters. We've got information here. We've got links on the first slide that we showed here. We've got links to all the previous sessions. So if you want to go and view those, or even view the slides, those are out available. Again, we appreciate your time and attendance, and have a great evening or great rest of your day. Take care. Bye.
Bye.